Good morning, ma'am. Please unmute your audio option, ma'am. Please, ma'am. Okay, ma'am. Ma'am, please start the session, ma'am. Please, ma'am.
Yes, sir. Yes, sir. I'm starting, sir. So, a very good morning. Respected principal ma'am, esteemed resource person, honorable guests, faculty members, and dear participants. Again, a very good morning to everyone joining us today. It gives me immense pleasure to warmly welcome you all to this national webinar on wealth creation through financial planning organized by Guru Nanak First Grade College, IQAC and Department of Commerce, Bidar, Karnataka, in collaboration with the Association of Mutual Funds in India. We are delighted to connect with all of you virtually through this online platform. Even though we are meeting from different locations, our shared commitment to learning and financial empowerment brings us together today. In the present times, financial literacy has become an essential life skill. Proper financial planning enables us to secure our future, achieve our goals, and build lasting wealth. This webinar is designed to create awareness and provide practical insight into managerial personal finances effectively, understanding the benefits of mutual funds and adopting smart strategies for wealth creation. So we honor to have us with distinguished expert Mr. Veera Brahma Rao, Senior Consultant, AMFI and former General Manager, SBI. He will share their valuable knowledge and experience. I am sure, sir, such a session will guide us to make informed financial decisions and inspires us to take proactive steps towards a secure and prosperous future. I take this opportunity to thank our respected principal, Dr. Shamla V. Datta ma'am, and management for their constant encouragement and support in organizing this event. So with these words, let us start this enriching webinar. I wish you all an insightful and engaging experience. I would like to request everyone to keep your camera on and mute microphone. Thank you. Now, I request respected Principal Shamla V. Datta ma'am to welcome the guest resource person and all other participants to this webinar.
Dr. Shamlal, ma'am. Ma'am, please unmute your audio option, ma'am. Please, ma'am. Dear ma'am, some technical issue. Okay, ma'am.
Good morning, everyone. Warm greetings to everyone present here. It gives me immense pleasure to inaugurate this national webinar on wealth creation through financial planning, organized by the Internal Quality Assurance Cell and the Department of Commerce of Guru Nanak First Grade College in collaboration with the Association of Mutual Funds in India. At the outset, I extend a hearty welcome to our esteemed resource persons, distinguished guests, participants, and students from across the country. In today's rapidly changing economic landscape, financial literacy is no longer an optional skill. It is an essential life skill. As educators and institutions, it is our responsibility to equip learners with the knowledge and confidence to make informed financial decisions. This webinar is a significant step in that direction. Wealth creation is not merely about accumulating money. It is about achieving financial security, realizing aspirations, and contributing meaningfully to the growth of the nation. Through proper financial planning, individuals can harness the power of systematic investing, understand the nonsense of mutual funds, manage risks wisely, and build a secure future. I'm delighted that this program brings together academic expertise and industry insights. The Association of Mutual Funds of India has played a pivotal role in promoting financial awareness, and we are honored to collaborate with them. Their involvement today ensures that participants will gain practical perspectives and go beyond textbooks. I congratulate the Department of Commerce and the IQAC for their initiative in organizing this relevant and timely event. I am confident that these sessions planned today will empower all of us with valuable knowledge and also inspire responsible financial behavior and encourage us to share these insights further in our communities. So before I conclude, I would like to quote Warren Buffett, who said, "Do not save what is left after spending, but spend what is left after saving." May this webinar ignite a commitment to each one of us to plan wisely, invest prudently, and work towards sustainable wealth creations. Once again, I extend my best wishes for the success of this webinar and declare it inaugurated. Thank you and have a fruitful learning experience. Thank you.
Shall we start? Any other, madam? Yeah. Respected Dr. Shyamala V. Datta, madam, Principal, Guru Nanak First Grade College, Bidar. Dr. Puranisa, Head of the Department of Commerce, and Dr. Sanjay Mainali, IQAC Coordinator, Internal Quality Assurance Council of Guru Nanak First Grade College, and dear participants. Thank you very much for giving us this opportunity to present the Financial Literacy and Awareness Program, through which the financial planning can be arrived at in a much sophisticated way and a much planned way. Let us, start with this. First, let us try to understand this. Financial literacy and awareness is the pathway to your future, financial future or your future. It gives an idea of how to manage your expenses and savings within available resources. This is a very, very important concept. And generally people feel that, they know everything and they can manage. But unless there is a prudent financial planning, and unless you are aware of the financial planning and other things, it will be slightly difficult because you encounter so many emergencies, exigencies in this thing, children's education, health issues. With all these things, you have to save. As Madam has said that, Principal Madam has said that it's not an optional skill. It is a life determined skill which you have to, prudently practice so that your future, financial future will be taken care of. Yeah, let's go ahead. Let us try to understand what we are presenting in the backdrop of our mutual funds and other things. Okay. Next. Yeah. Let us try to understand what we are doing with our money, what we are earning, your income, your business income or professional income, whatever it is, your salary income, what we are doing. We are spending first. Let us try to meet our own expenses. Then we are saving. Some people who are aware of this financial planning and other things, they also try to the saved money can be invested in much better way so that it can yield you some good results. Next. Yeah, Madam has already quoted this Warren Buffett's famous quote. I need not elaborate on this. Is don't save up what is left after spending. It is you save first and then spend whatever left. Okay, next. Yeah. Yeah, generally with the savings, what happens? Okay, as a prudent person, you're from a portion of your income you're saving. But what is happening to your savings? Also try to understand. That is very, very important. Unless this awareness is there, it will be, you thought that you are saving, but it may not yield the desired results the way you expect. Because there is a concept called inflation. In any economy, you find this inflation. If your saving is a full, compared with a full apple, but after some years, maybe 5 years or 10 years, that apple comes out with a portion of it is being taken off in the form of inflation. Inflation eats up your savings. Please remember that. Next. How inflation has eaten your savings and expenses, how the expenses gradually keep on increasing is shown in in this table. And you see this today, you are spending 30,000 rupees. Assume that today you are spending 30,000 rupees and to meet your whatever expenses that are required for a decent standard of living for you. And after 5 years, this, if you want to, expect that these same 30,000 will meet your requirements, not possible, because there is a concept called, as we have already said, it is inflation. So the same expense, what you call the requirements, what you are having today, after 5 years for the same requirements, you may have to spend 40,000 rupees instead of 30,000 rupees. Similarly, after 15 years, the same, assuming that no increase in your spending or your needs and other desires. Even for that, after 15 years, for the same needs and the desires, you have to spend double the amount, 60,000 rupees. Similarly, 80,000 rupees after 20 years. This is how the inflation will creep into your income or this thing and your expenses portfolio. Similarly, savings also, when the savings, on the expenses side, it will keep on increasing, whereas on the savings side, the value of your potential savings will gradually decrease because of the inflation, which is depicted in this diagram. Today, you are saving 1 lakh. After 5 years, the value of the 1 lakh is 80,000. And 15 years, 50,000. Similarly, it's only an example, not that exactly it will happen this way, but idea is to tell you that your savings will not have the same value of today after, say, over 5 years or 10 years or 15 years. try to, appreciate this concept, inflation, impact of inflation. Next. Yeah, what is the solution? Okay, we said that there is you're having your savings and there is a concept called inflation. Then what is the, how to protect yourself from getting impacted by this inflation? So this is the solution. That's what we are suggesting. Start saving. The earlier you start, the better, because the tendency is in the earlier, younger days, you try to spend whatever you get, but a prudent financial literate person has to start the saving from day one and progress. Second step is understanding from a concept called saving, you have to develop to investing. Saving is one thing which may yield you a return, but investment definitely will yield you better results than in savings. Then that is the investment means what? Putting your money to work, even though you need not, slog it for it. Some experts will, do it for you, and that money will be put into use by investing in various prudent schemes, so that your savings, which is invested, will yield desired returns. So, when you're working very hard to earn your money, you should also expect and aware that your savings and investments also should work hard for you, so that your future will be taken care of, maybe by taking the advantage of impact of the compounding effect, because you are not drawing it. What you are investing must be yielding some results. You are not withdrawing it. So if you are reinvesting it in your investment, so you will get the impact of compounding effect. We are all aware, common students, we are all aware what is a simple interest and what is a compounding interest. Next. So then let us try to understand, having a literate, financial literate, being a financial literate and aware person, let us try to understand what is financial planning is all about. Financial planning is like this. Define your financial goals. What exactly you want to, maybe say after 10, 15 years, what exactly you want to achieve, what exactly is your objective. Define your goals. And then also assess what is your income now, what is your current financial position. So you cannot, in isolation, you cannot keep on dreaming. This is my financial goal, I want to achieve this, I want. It has to, a relation between your financial goal as well as your current financial income has to be there. Otherwise, there's no point in discussing about financial literacy and awareness. So aware of assess your current financial position, then create asset allocation. So don't keep all the eggs in one basket is the famous quote we always hear. So that will create problems in case if you keep everything in one basket. So you have to, as a prudent financial literate, you have to diversify your asset allocation with your savings. That after you decide on the assets, this much portion I will go into real estate, this much portion I will invest in gold, or this much portion I will invest in bank deposits, this much portion I will invest in mutual funds or shares or whatever it is. After deciding the asset allocation, accordingly, you try to stick to that plan and invest accordingly. Last and most important thing is, very important thing rather, keep on modifying, keep on, monitor your investments in the asset allocation and see which asset portfolio is not yielding the desired results and which asset portfolio is yielding desired results. That monitoring is to be there. Otherwise, there is no point in just investing and forgetting about it. Next. Why is this financial planning important? Why at all we should plan. See, we have already discussed the pathway, a literate financial person. This financial planning is the pathway for your financial future. To reach your financial goals faster. If you are taking a laissez-faire approach, like, okay, let us see, tomorrow we will invest, something like that, no, that will not give you a cushion of safety net. Whereas a person who starts saving and investing from day one has, it will help him to achieve his financial goals in a very, very disciplined manner. Not only that, it will also increase your standard of living, because the investment or saving what you are doing also yields returns. Thereby, if you are earning, X amount of rupees as a salary or business income, this X plus, the plus part of it is the return that you are yielding it from your investments. So this X and X, this X plus will give you a very good, decent standard of living. Further, the most important third step is it keeps you equipped and to face emergencies, like, health issues. Suddenly there is a health issue in the family or financial emergency, anything, maybe parents or elders, family has suddenly gone, they have become sick and you have to attend to them. These are all, emergencies. And children's education is another of this thing. You want to keep your children in a very beautiful or a very well-reputed school. That requires a lot of money for that. So you have to equip yourself by saving and investing for the financial emergencies. Another important concept also is, when you are earning money and health. Financially you are secure, your financial planning is yielding desired results, you will achieve this, peace of mind. You need not worry what happens or what will happen tomorrow, because you are sufficiently equipped to meet the financial emergencies and also at the same time to achieve your financial goals. Next. Yeah. Again, this is another important quote by Warren Buffett. We keep on, falling back on this, which gives you a lot of insights. Don't depend on a single income. Like, I'm earning salary, that single income is okay, fine. You will have a decent living. But if you want to improve your standard of living, you have to plan for your, financial future by saving and investing, so that you will get a second income from your investments. That's what he says. Never depend on a single income. Make investments to create a second source for you, so that you will lead a decent life in the society. Next. Yeah, this slide shows investing in the right assets. Asset portfolio, we already discussed. What are the asset portfolios? Real estate, gold, shares and bonds, mutual funds, and other corporate bonds and other things. You can choose the asset classification. So investing in the right asset can help create wealth in the long term. This is how it has. This shows the Sensex. Sensex, you are all aware, no? BSE and NSE, the stock exchange indicators. So how they are yielding results, in the over a period of how many years? 30, 40 years. How much compounded CAGR they are earning. by investing in these shares and stocks and bonds, other mutual funds. This is how your investment is growing. 16.2, 15.5%. It varies, but definitely it yields, very good return for you, so that, you will upgrade your standard of living. You will meet your financial emergencies. Next. Same thing is being depicted in a graphic form. This is how 79 to maybe what you call up to 2014 or 19, they have depicted how gradually your investment portfolio has yielded very good returns over a period of 30-40 years. It is being depicted in a graphic form. Next. Yeah, we have already discussed this. Determine what are you investing for. The financial goals, you should have a financial goal. So because of that only we are investing to secure your financial future. Always, your investment should be goal-based. Always invest in an asset with your specific financial goal in mind. Like after 5 years, I want to acquire a house. After 10 years, I want to acquire, a house plus, a car, and maybe children education, to join them in a very good, reputed high school at a costly, particularly a better school with a lot of infrastructure and reputation. So all these things, these are all goals. At what time you want to have things. Next. What are the various options? To achieve those financial goals, what are the options available to you? Is gold, what we have said, assets, various assets, gold, property, stocks, insurance, bonds, bank deposits. Besides this, there is another big chunk where your investment yields desired, decent returns, of course, subject to market conditions. That is called mutual funds. Mutual funds is relatively less volatile and than the stock market and other investments. May yield better results than the bank deposits, and also very liquid. Whenever you require, you can get it within a day or two, depending on the scheme you are investing in. That's why various options we have given, we have shown you, so that you can choose based on your financial goals. Next. Yeah, make your investments work for you. That's what Warren Buffett's this thing, to have a second source of income. Your investment should always remember, these are the 4, 5, 6, 5, characteristics and the prerequisites when you're investing, you should see for. What is that 5 characteristics? Your investment should be fighting inflation for you. And second, provide reasonable return and income when you need it. Third, it should be easily accessible, just like a bank deposit. You just go to the bank and encash your deposit. In the similar fashion, you should be in a position to encash it and use it in portions, whenever you require. Not necessarily in bank deposits. The problem with bank deposits is if you invest a lakh of rupees, you got only 10,000 rupees urgently, but you have to break that 1 lakh rupees fixed deposit, which you don't get anything out of it. Maybe small return only you will get. Whereas here in mutual funds, what happens? You will, encash it in small units also. Whatever is requirement, whatever is your requirement, based on that. Fourth point is very important point. It grow in value and appreciate over time. Bank deposit, it only yields some return. Whereas here in mutual funds, if you look at it, the value of the mutual fund also grows over a period of time, and also it will yield very good return for you year on year, quarterly basis. You can take it as a quarterly or half yearly or yearly basis. That's how it not only grow in value, but also in appreciates over time. And last and but not the least is realizable at a fair value and at a very, very low cost. If you break your fixed deposit, what happened? If you invest for 5 years at a rate of 8%, if you after 1 year, if you break it, you will get only 3-4% return. Because whatever 1 year rate of interest is there, minus something they will take as expenses, and then as a penalty or whatever you call it, and then they pay the remaining amount. Whereas here, because the investments in mutual funds are in units, how many units you want to withdraw? 10, you may have say 10,000 units. You want only 1,000 units. That is 1,000 unit rupees. Maybe 10,000 rupees only you require. So that 1,000 only you can draw. The remaining 9,000 units will be appreciating and in value, as well as keep on yielding the desired returns on that investment without any break. So only this 1,000 units only you have withdraw for your immediate requirements. That is how it has to be a realizable fair value, and also it at a low cost I can withdraw my funds whenever I require in an emergency. For that, proper asset allocation, for achieving all these 5, you should have a proper asset allocation. Yes, next. Yeah, you must be seeing this, thali. Your investment should be like this. Your asset allocation should be like a thali. So you have several options, in this thali. Your, a balanced thali. You have a roti, rice, rasam, sambar, curries, all these things, curds, sweet, everything is available to you. This is your investment, your asset. It should be in asset allocation, a proper asset allocation, which represents like a thali. Next. Yeah, not only it should represent like a thali, but it also meets your financial goals. Very important. Just like that, okay, I have invested in 3-4, but ultimately, when your financial goals are at variance with what you have invested, what the asset allocation you are invested for, are not matching, then not much of an use for immediate use whenever you require. So asset allocation should match your financial planning and goals. Very, very important concept. So investment that can grow in value. If you look at it, as we have said, your investment should grow in value as well also returns. 2 portions. So this value, which are the investments that can yield value, grow in value: properties, gold, art collection, equity shares. This it will grow in value. And what are the investments that can generate income? Bonds, NSE, National Savings Certificate, Kisan Vikas Patra, PPF. These your principal is intact, and it will generate some income for that, for you also. But grow in value and income. The value will not increase. If you have invested 10,000 rupees in Kisan Vikas Patra, your NSE, the 10,000 will be intact. Only you will get return on that. The 10,000 will not grow in value, or it will generate you some income. Whereas in mutual funds, it is the combination of both. It grow in value as well as it will generate income for you. So decide, ask yourself a question: are you investing in right assets? Asset classification is being done properly by you or not? Next. So when we say that mutual funds are having both, this grow in value as well as returns, so let us discuss about what exactly the mutual fund. What are the types available for you? What are the kinds? Next, how it operated. Sorry. Let us try to understand what is a mutual fund. The name itself says the mutual. Mutual means it is, helping each other. Mutual. It's a mutual fund. A mutual fund is a financial vehicle scheme that collects money from many stakeholder investors and invests in securities such as stocks, bonds, and debentures. This is the mutual fund function of the mutual fund. Anybody with an investable surplus can invest in mutual fund with as little as a few hundred rupees. Not necessarily you have to invest in a substantial lump sum amount of lakh or 10 lakhs or 5 lakhs. Not that way. Even a 1,000 rupees you can invest in mutual fund. Investing in mutual fund is the most cost efficient as well as very nominal charges for the investor, unlike in other where if you go for land and other things, you have to pay registration fee and all these things will be there, accompanying expenses. But here the investment is with a very lowest charge. You can go for mutual funds. Most important aspect of another characteristic of a mutual fund is this fund is being managed by experienced and qualified, reputed fund managers who have the expertise in studying the financial markets. They do the investments on your behalf. So when you invest in a scheme, the fund manager of that scheme will invest in by studying the market conditions and in shares, bonds, and other things on behalf of you. So your investment is being taken care of by your fund manager, who is supposed to be an expert in the area of investments. Another important is it yields market returns. Not unlike a fixed deposit where you will get when your funds are locked in a fixed deposit, you keep on getting only that locked amount, that 8%, 5%, 6% return. Whereas here, it yields as per the market conditions and market rate. Market returns are being given to the investors in mutual funds. In the long term, market returns have the potential to perform better than the other asset classes what we have discussed, because we are investing in market market returns are being given to us for our investment. It will, in the long term, it has a potential of growing in value as well as giving you decent returns. Next. Yeah, it's again a graphic, it's this slide shows how this mutual fund works. See, here you are the investor here. You are there, you pull up your money, a fund manager, and invest in a mutual fund. A fund manager, that entire fund will be given to a fund manager based on his expertise. He starts investing on behalf of the investors, and in where he will invest in stocks and securities, which will help generate decent returns. And these returns, after netting of expenses, very prudently the expenses will be there, and after netting of the expenses, the returns which are generated by the your investments which are invested in the mutual fund will be distributed to the investors, delivered to the investors. Next. Yeah, why investment in mutual funds? Again, we should ask all these questions when I'm giving you or suggesting you to go for mutual funds as one of your asset classifications. You should ask why I should invest. Because I have gold, I have real estate, I have bank deposits, I have NSCs, I have PPF. Why should I go for mutual funds? Because these are the reasons: low cost, professional management, risk diversification, transparency, liquidity, and in convenient small amounts you can invest instead of a lump sum, which are the requirements in other asset classes. Whereas here you can conveniently in a small portions you can invest. And finally, this mutual fund industry is being well regulated by Securities Exchange Board of India, SEBI. You must all have heard of it. Very regulator for all the mutual funds, and a very well reputed regulator in this aspect. So your investments in mutual funds are very safe, and transparent operations will be conducted with a lot of liquidity. Next. Yeah, let us, because we are dwelling, we are suggesting for investments in mutual funds. First, we have understood what are these things. Then let us try to understand this mutual fund structure and schemes. Next, various schemes that are available to you. Next. Yeah, here mutual funds, as the name suggests, it's a mutually beneficial for the investor as well as the fund houses. So there will be a sponsor, because it's a mutual beneficial scheme. This started as a trust. All mutual funds are trusts. Trust, we are all aware that trust is the name itself says that the investor trusts and the sponsor and the asset management company will try to uphold the trust that are being given, reposed in them by the investors. So the structure will be like this. There will be a sponsor, main sponsor. Say you take, Aditya Birla, State Bank. Sponsor will be Aditya Birla Group. They started a mutual fund, Aditya Birla Mutual Fund. So there is a sponsor. Directly they don't start. They created a board of trustees. Board of trustees, they will start an asset management company. This entire mutual fund, is being run by this asset management company. The trustee will start this asset management company, and then there will be investors like you and me, and this asset management company floats a mutual fund, and the investor invests in this mutual fund, and the day-to-day operations of the fund management, we call it, is being done by the investment management, and the fund manager will be there. They will do the day-to-day operations of the mutual fund in that particular scheme, and there will be a custodian. When the operations are there, we invest in securities, bonds, and all these things to safeguard those securities and bonds. There will be a custodian for that. This is how the structure operates. Under the asset management company, you have agents and distributors who actually popularize and sell these mutual fund schemes. There will be bankers. Bankers also sell as an agent for the mutual fund schemes. And there will be fund accountants in the asset management company. This is how the scheme works, mutual fund structure works. Next. Types of mutual funds. Then after understanding the structure of the mutual fund, let us go for types. What are the types? So there are several types, depending on the nomenclature and nature of the scheme. The organizational structure is, in the organizational structure, you will get open-ended funds, closed-ended funds, interval funds, and management portfolio, active funds and passive funds. There are various schemes that are available depending on the investment objective, growth funds, income funds, and hybrid funds. Investment portfolio, the investment in the equity portfolio, debt portfolio. These are the types of mutual funds. It only gives you what are the various types that are. You can choose the type of mutual fund depending on your risk appetite. Okay, next. categorization of mutual funds, and again, if you look at the categorization, it is the schemes are being classified as 4-5 under head, 4-5 heads. What are the heads? First head is equity schemes. Generally, majority portion of the your investments collected under the scheme is invested in the equity, and their priority is equity investments. And similarly, because the priority is there, the returns are also dependent on the that categorization of the mutual fund. If it is an equity mutual fund, the risks are much better, higher, and also returns are also higher. Risks and returns are correlated. Actually, they are interlinked. Debt schemes, a slightly safer way of investment, because that debt schemes only yield interests and other things. So these are all very safe, schemes. Hybrid schemes. Hybrid means what? Both equity and debt. A combination of both will be, the schemes are being floated under this head. Then solution-oriented. Solution-oriented, retirement plan, children education, because these are the solutions. After your retirement, if your company is not providing you a decent pension, or you don't have a pension scheme at all, this type of funds will help you to generate regular source of income after your retirement, depending on your objective. Children's education. When a child is born, if you invest in a children's education fund, maybe after 15 years or 10 years or 15 years, when your requirement is there, that fund will give you a decent, not only growth, and also in value also it increases. So this is how the solution-oriented schemes operate. Other schemes like index funds, exchange traded funds, these are all linked to the stock exchange, BSE and NSE, linked to their whatever returns the BSE and NSE that stocks that are giving. These schemes are also, because they are investing, they are tagging to the index and Sensex funds. They're all, yield decent returns, similar to the index returns. Next. So try to understand the various types in a detailed manner. First, let us take up equity schemes. Next. Equity funds. These schemes, generally the funds collected under this scheme, mostly invest in equities and equity-related instruments of companies. So the returns also depending on the performance of these companies and the performance of the share of that company. Then seek growth in the long term and can be volatile in the short term. Another important characteristic of this fund is, in the short run it may be slightly volatile, but in the long run, if your risk appetite is much higher, you can wait for a decent returns. You can invest in this type of equity funds where you seek growth in the long term, can be volatile in the short term. Remember that. Next, suitable for investors with risk appetite, high risk appetite. Categories. Let us understand the equity categories. What are the equity categories here? Multi-cap fund. It gives you an idea, at least 65% of investments in equity and equity-related instruments. Multi-cap. Large cap, 80%. They will tell you upfront, in the scheme document itself, they will tell you where they are going to invest and how much percentage of the entire fund will be invested in that type of this thing. In large cap fund, 80% equity and equity-related instruments. Large and mid cap, combination of these two. 35% investments in large cap and 35% in mid cap. These are all companies. Large cap and mid cap is size of the large cap companies and mid cap companies. So these are all the as per the BSE Sensex, they categorize companies based on various criteria as a large cap company or a mid cap company. So It's large and mid cap company, 35%, 35% in large cap and 35% will be in mid cap. In mid cap exclusively, again 65%. Small cap, again, the major portion of that, savings, investments collected under the scheme will go into the nomenclature of the scheme. 65% in mid cap, 65% in small cap fund, and flexi fund. Flexi fund is also a fund which can, invest in, both this type of what you call mid cap and small cap companies. Next. Yeah, this is equity funds. Another categorization is dividend yield fund, value fund, contra fund, focused fund, sectoral thematic fund, and ELSS. These are the various type of funds that are available for you. You can choose based on your risk appetite. Only with this thing, ELSS is 80% stocks in the equity linked savings scheme 2005, which will yield desired tax benefits too under that category. Next. Equity linked savings scheme given in a detailed way. Deduction from taxable income up to 1,50,000 under Section 80C. If you invest in the ELSS, you will get this additional benefit also, but your investment will be slightly locked in for some period. Investments, second is investment predominantly in equity helps generate market-linked returns. Short lock-in period, I said 3 years. If you are investing in this ELSS, your investments will be you cannot withdraw up to 3 years. Your investment will be locked as compared to other tax saving options. Next. So we have discussed about equity schemes, and then let us focus on debt schemes. What are debt schemes? These are all under mutual funds only. Remember that. Next. Debt funds are investment, these funds, when you invest in a debt fund, the investments collected under that scheme is invested in different types of fixed income securities. Securities that are yielding a fixed regular income. They will choose, and accordingly they will invest in under those, fixed income yielding securities. Aim to earn interest income and slightly capital appreciation too. Then suitable for investors seeking returns with low to moderate risk. Under equity schemes, your risk appetite is slightly higher. You can take higher risk, and thereby you can get higher returns too. Market related, depending on the market conditions. Whereas debt funds, it's a stable source of return, like moderate. It's only carries only with low and to moderate risk only. That's why debt funds for a certain segment of people who are looking for safe returns, debt funds are ideally suitable. Next. Yeah, types of funds they have shown in this matrix actually. In the y-axis on this matrix, risk is projected, whereas in the x-axis the duration and maturity period is projected. So the risk is is low. The diagram clearly shows which is the lowest risk category, contra fund and other things, and money market funds, corporate bond funds. So these are all the risk involved in this type of things are mostly debt funds, particularly long duration funds. These are all under this category. Low risk they carry, whereas high risk categories are gilt funds with 10-year maturity, credit risk funds, all this equity related things, and gilt funds also carry, because 10-year maturity, you never know how things will happen. So they carry slightly higher risk. So depending on your risk appetite, your analysis, your financial, goals, you can invest in these funds. Next. Debt fund categories, again, there are, as in equity funds, here also there are several fund categories are there. Debt fund category is overnight fund, that means 1 or 2 days. You can keep your idle money in that kind of fund, and for 1 day you will get some return. The overnight fund, liquid fund, maybe 90 up to 91 days. If you don't require your funds up to maybe say 3-4 months, so you can choose the liquid fund. Ultra short duration fund, it is a 3 to 6 months period. If you have a liquidity at your disposal, so you can go for this type of funds. The reason being, just to, instead of keeping it idle without yielding any return, when you invest in overnight or liquid or ultra liquid short duration fund, your fund will yield return, some return. So that is why the debt fund category is given, and low duration fund, 6 to 12 months, money market fund, more than up to 1 year, 1 year to 3 years in short duration fund. Medium duration fund is 3 to 4 years, and 4 to 7 years is medium to long duration. This is how the debt funds are classified, and depending on your financial goals and financial requirements and your liquidity position, you can go for a suitable fund which suits your risk appetite. Next. Same thing, what we have already seen in that diagram, matrix and other things. Long duration fund, dynamic fund, corporate bond fund. Dynamic fund is, it invests in various across duration. Securities duration from maybe 1 year to 6 months to 10 years. They will invest in portion of it here, portion of it there, and other thing, so that they will invest in various across the duration of the securities. Corporate bond fund, 80% investments in go to corporate bonds. Similarly, in equities, the scheme will tell you upfront where they are going, where the investments you are making are going into, where they are going to manage your, by investing, where your portfolio is getting managed. They will tell you upfront. Gilt fund, 80% will go to G-Secs. Gilt fund with 10-year constant duration. These are all, gives you an idea how much and what is the period and how much you are going to, the return, the reasonable return, whatever this thing is. Depending on your risk appetite, you can choose, the fund that suits your risk appetite. Next. Yeah, we have covered equity, we have covered debt. Then let us see what are the combination of both. Hybrid schemes, equity and debt. This is called hybrid schemes. They go for, part of it will go to part equity and part of it will go to debt, so that your risk is balanced. That's called hybrid schemes. Let us see what are the hybrid schemes. Next. Yeah. Hybrid funds where, what are the characteristics like? These hybrid funds invest in a mix of equities and debt. We already said that. Aims to generate wealth from equity exposure, while the debt portion fortifies them against any downturn. You are aware, generally Sensex, the downturns, sometimes, there a lot of volatility will be there in the market, and sometimes your portfolio will get impacted by that volatility also. So, to ensure against that type of volatility, portion of it is also invested in debt funds where a regular source of income is assured for the what you call aim to generate wealth from equity exposure, while the debt portion fortifies them against any downturn, because slightly some return will come out of your debt funds. Then hybrid funds who are actually likely to invest, or whose risk appetite qualifies for this type of investments. Suitable for investors for looking for a mix of safety, income, and modest capital appreciation. when you are looking at with these three objectives, when you are investing, hybrid funds are better funds. Next. Again, in the hybrid funds, there are various categories. Conservative hybrid fund, 10 to 25% invest in equity and the remaining in debt instruments. Balanced hybrid, 50-50, 40-60, depending on the objectives of the scheme. Then dynamic asset allocation or balanced advantage. This scheme, what it says, investment in equity debt that is managed dynamically. It's not fixed, like percentage is not fixed, unlike in the other earlier two schemes. It is dynamically, depending on the market conditions and other things, the fund manager will keep on investing in a dynamic way. Multi-asset allocation, instead of going for only one asset, this thing, they go for multi-asset, classes. The investments will flow into these multi-asset classes. Arbitrage fund, you are all aware. Arbitrage fund is a hybrid mutual fund that generates returns by investing in one market and selling it in another market. This is called arbitrage. To give you an example, arbitrage is how the arbitrage fund works. I'll give you a simple example. When I was working in abroad, people used to take loans because interest rates abroad at that point of time on loans are very, very minimal. 2%, 3%, depending on your maximum 3%. Even 1% also people used to get at 1% rate of interest, depending on your credit history and credit score. They used to take loans there at 1%, 2%, or 3%, and try invest in Indian markets where the fixed deposit itself was yielding 8 to 10% during that period. So if you, for example, if you take 3% loan at 3%, and your fixed deposit in India is yielding, which was invested, the same loan invested in the fixed deposit is yielding 8% or 9% in Indian market, fixed deposit, the safest way. So the difference between these two, 3 and 9, the arbitrage is 6%. People used to get, take advantage of that arbitrage. Similarly, the funds in mutual funds, the categorization of, the fund itself is try to invest in such type of avenues so that the safety and of the investment as well as return is slightly assured. And equity savings, again, hybrid funds means what? If equity savings means equities, they will invest 65% and debt instrument 10%, and derivatives also they go for it. Like derivatives means in forward contracts. You think of say in during over a period of time, maybe in the next 6 months, you enter into a futures contract, futures options, put option, call option. These are all there in the forwards contracts. They invest in those derivative instruments so that your fund will get you slightly balanced returns. This is called hybrid funds. Next. Solution-oriented other schemes we have already seen. Next, that is retirement. Next, please. Retirement funds, children's education fund, exchange traded funds, and fund of funds. Fund of funds means, just I want to give you an example. Fund of funds, the investment objective is they don't choose any this thing. This fund will not directly invest in equity or bonds. What they do, they invest in the other mutual funds where the portfolio is already, maybe equity or debt or whatever it is. In that type of funds, they choose those funds which gives you slightly protect the growth as well as the return aspect. The fund of funds means that they will invest in those funds, not directly in equities or this thing. In the mutual funds only, they will invest. Next. Index funds. We told you the index funds reflect the indexes which they tag. Portfolio replicates the index, the BSE, Sensex, or NSE, NSE. They replicate. Aims to provide returns in line with the movement of the index. Suitable for investors seeking returns similar to index. BSE index and other things, if it is yielding BSE, despite all its volatility, if the investments in the BSE is yielding 11 to 10% to 12% or something like that. So this fund also, because they invest in that type of Sensex related funds, their returns are also will be in tune with the market returns of those index funds. Yeah. Next. Index funds. What are the characteristics? There are 6 characteristics were given to for index funds. Let us try to understand what exactly is index fund. Mirrors a market index. Market means BSE, NSE. That this fund mirrors that market index. Then includes securities as per index and in the same proportion and weightage. Sensex, small cap, mid cap, multi cap will be there. No, they classify the shares in such categories: mid cap securities, the large cap securities, and the small cap securities. So these investments also in the proportion of the weightage that was given to these mid cap, large cap, and small cap securities in the index. Similarly, when you are in the index funds also invest in such, depending on the weightage, the Sensex and other things are giving. It's more of a passive fund management because index decided tagged shares and bonds only this fund is going to invest. So the fund management need not be that active. It's a passive fund management, but they have to be alert always. That's very remember that. But slightly unlike in other equity schemes and other things, it's more of a passive investment. Aims to offer returns, undertake risk similar to the index it tracks. If the index linked shares and bonds are slightly yielding maybe 10%, 8% return, these funds where they are also, because they are also investing in similarly tagged shares and bonds, the fund also will generate similar return. Then fee also is capped at 1.5% fee of the mutual fund, and complete transparency because it's an index related fund, index tagged fund. What happens? You can whatever index shares and bonds are there, identified shares and bonds, the fund will invest in that only. That's why it's called passive fund management. Thereby, because they are investing in those stocks only, a lot of transparency is visible in this type of index funds. Next. ETFs is exchange traded funds. Exchange traded funds means track an index, a commodity, bonds, or basket of assets. They identify which of these they want to track. Accordingly, their investment strategy will be in those tracked areas only. Trades like a common stock on this, because this fund, the units are listed on the stock exchange, ETF. The name itself says that exchange traded funds. Exchange means Bombay Stock Exchange or National Stock Exchange, whatever. This is exchange traded funds. So these units are also, the mutual fund units are also listed on the exchange. Accordingly, you can trade them in the stock exchange. Again, passive fund management, because it's an index tagged fund. Fund management is very passive. Lower cost of fund management than the active funds. Active funds means because the fund manager has to be very, very active in disposing of our investments and other things, very alert, so that the turnover will be more in those companies. The expenses, when the turnover is more, the expenses also ratio also slightly will be more. Whereas here, the fund management is passive fund management. So the churning of the portfolio is, by the fund manager may not be that frequent. So your cost of fund management is slightly less. Next, gold exchange traded funds. These are all the gold exchange traded funds. Investments in pure gold. These funds, they invest in pure gold bullion of 99.5% purity. May also invest in gold-related instruments approved by SEBI and the gold deposit scheme of banks up to 20% of the net assets. These are the gold, the characteristics of gold ETFs. Price of the gold ETF unit moves in line with the domestic price of the gold. These gold, mutual funds, ETF, exchange traded funds are benchmarked with the price of the gold. That's very important. When the price moves up, generally gold price, and except in few occasions, it will never go down. So it keeps on moving higher. So because it's benchmarked against the price of the gold, you will also get the value of your investment also will grow. Next. International funds is again a distinct, category under this category, mutual funds. One is the investments collected under this fund scheme are being invested. Part of it will be in international market by holding one or more of the following: equity, debt of companies listed abroad, ADR, GDRs of Indian companies, debt companies listed abroad. Debt of companies listed abroad. Some of the companies, Ready Labs and all these companies, they are listed in the, New York Stock Exchange and other things. So when they are, you are investing it, because these funds invest in that type of, Indian companies, ADRs and GDRs of Indian companies, you will get the returns which the exchange traded funds are giving in other countries. You will also get here. Passive index funds in other countries, units of actively managed funds in other. So the investment will be done in passive funds as well as actively managed funds also. So you will get a mix of this thing. So because benefits of both, the volatility will be less when you spread your portfolio into passive index funds and actively managed mutual funds. Next. Fund of funds is again another very important type of mutual fund. Fund of funds invest in the units of another mutual fund. We have already discussed this in when the types of this thing. So instead of investing directly in shares and bonds and this thing, they invest in the mutual fund units of other mutual funds. So whatever return, based on, they will look into that before investments, they will look into the objectives of that scheme and other things. Then accordingly, they invest in the funds of other mutual funds. So the returns are also similar to the funds that are invested, other mutual funds returns. You will also get. The fund management cost includes expense of a fund of fund along with underlying schemes. Investing in FOF helps diversify the portfolio. Very, very important is it helps you to diversify your portfolio, investment portfolio. Next. Arbitrage funds. We have discussed what is arbitrage. Refers to practice of buying a security in one market and then selling it at a higher price in another market. Taking advantage of the differences in prices in various markets, the arbitrage funds work. So suitable for cautious investors who want to benefit from the arbitrage without taking much higher risks. That means the risk appetite will be low to medium only. That type of investors can go for this type of arbitrage funds. Next. Yeah, mutual fund scheme. Which one to buy? Again, nothing but risk return trade off. What type of scheme you have to invest? Because we said equity schemes, hybrid schemes, debt schemes. Return. What is it called? Return. No. What is this? This is last one is index funds and hybrid funds. Fund of funds and all these things. Which one you have to go? schematic funds rather, retirement, children education, and other things. No, that comes in the last category. So which one you have to invest will be dependent on your financial goals and your risk appetite and your risk return trade-off, what you are looking at. This is how this scale. You have to assess where to invest. Next. What are the, when you are going for mutual fund investments, what are the documents that you have, one investor has to look into? There are various types of documents. Let us go through them. Next. Scheme Information Document, SID. It gives you the entire detailed information about the scheme, where they are going to invest and how they are going to invest, who is the fund manager, what are the objectives of that fund. Everything will be given in detail in the schematic, scheme information document. Then additional information, there is called SAI, Statement of Additional Information. It contains information related to legal, tax, and general aspects of mutual fund. What are the legal aspects? What are the tax implications of your investments? And general aspects of the mutual fund. It is common for all. These two are common for all the schemes. One is Scheme Information Document, SID, and SAI, Statement of Additional Information. The key, another document called KIM. KIM means Key Information Memorandum. KIM is a summarized version of the SID. This is it's a summarized version. It's otherwise scheme information document will be very elaborate, and investors may not find time to go through the nitty-gritty and fine print. That is in the scheme information document. They can go for this KIM, a key information document. They also release with the key information document, summarized version of the SID. It includes key or essential details of that an investor must understand before investing. It very categorically tells you what are the important areas you have to look into before investment. It's called KIM. Next. Monthly, when you are investing in mutual funds, you will get a monthly fact sheet of the scheme. A fact sheet helps you evaluate a scheme, whether your investment, the objectives with which you have invested in that particular scheme, is it being achieved or not. The fact sheet helps you to evaluate. It is issued every month. A snapshot of the scheme and easy to understand by even an ordinary folk. Yeah? And a fact sheet shows the key information like net asset value, returns, riskometer, everything they give you in that fact sheet. Next. Plans and options. Next. Direct plans and regular plans. This is very important. Regular plan means this, you can invest through a with the help of a mutual fund distributor or agent. Comparatively lower NAV and higher expense ratio. Because why higher expense ratio? Because when you are investing through a distributor, the mutual fund has to pay a commission for the distributor for selling the products. So thereby the expenses ratio will be slightly relative to direct plan. The expenses ratio may be more. That's why the NAV, because the expenses are more, the net asset value also for a regular plan will be slightly lower than the direct plan. The direct plan is suitable for those people who are system proficient and who can operate their own internet banking and all those things. You can directly invest in the mutual funds by going into the respective mutual funds websites. Thereby, because there is no commission component that is involved here for the distributor or the agent who is selling it, the direct investment investor can get a higher, slightly higher NAV than a regular plan, and also low expense ratio. Because of this, there is no commission on the distribution and other expenses. Next. So in when you invest in mutual funds, there are two options available to you. One is growth option. The other one is IDCW, dividend option. Growth option is the which you will get compounding impact, where the returns generated in that scheme is also getting reinvested in the scheme, so that you will get compounding impact. So you will not get you will one minute. Sorry for the interruption. And this growth option gives you reinvestment of the returns that are generated in the scheme itself, so that the value and returns will grow over a period of time. The portfolio value will be much higher. Whereas income distribution come, IDCW, income distribution come capital withdrawal option is on a regular basis, at a timely intervals, your returns is being distributed to the investor, like quarterly returns, half-yearly returns, yearly returns is being given back to the principal will be there in the investment in the scheme, and only the returns generated, IDCW, will be distributed to the investors if they opt for this IDCW option. These two options are available for the investors. Next. Modes of investing, again, in a lump sum you can do, or there are another investment methodology called systematic investment plan. The systematic investment plan means every month or at timely intervals, you can invest in the scheme by way of a regular 500, 1,000, or whatever it is. You decide. It acts like a recurring deposit of the bank. Recurring deposit, monthly you can invest similar certain amount in that scheme. Similarly, SIP also will acts like that. Next is systematic transfer plan. Systematic transfer plan is transferring a certain amount from one mutual fund scheme to the other mutual fund scheme of your choice. So you feel that, okay, you have invested, say, some in scheme A today and give an STP, okay, whatever returns that are being generated in scheme A, please invest them in scheme B. Returns. The principal will be here. The returns that are being generated by scheme A are being invested in scheme B. So this is called systematic transfer of your choice. You can choose the fund where to transfer that amount, and STP, that's called systematic transfer plan. Then inter-scheme switches. Inter-scheme switches, within the same mutual fund, you have invested in equity fund scheme, suppose. Tomorrow you are thinking that my risk appetite may not be that great. So I want to shift to the debt scheme or a hybrid scheme. So you within the same mutual fund, you can ask the mutual fund to switching to another scheme than from the scheme you have invested in, for various reasons, depending on your financial goals. Next. SIP. What is SIP? You're all aware. SIP means allow an investor to regularly invest a fixed amount in a mutual fund scheme. This is similar to recurring deposit. That's what we have already discussed. Advantages are regular, disciplined way of investment, smaller quantity you can invest, averaging the cost of one unit. Suppose if you are investing today at a face value of 10, tomorrow the NAV may have to gone to 11 or 12. When you're investing over a period of time in the same scheme, SIP, through SIP, the averaging concept will work. And finally, when the NAV is 16 rupees, you started investing from 10 rupees, the average cost will come to you maybe 13 rupees of that, per unit in that scheme. This is called averaging aspect. Instead of, after you want to invest in 16 rupees, you have to pay 16 rupees. But when you keep on investing through SIP, your cost of investment will be averaged, and SIP will help you to arrive at that. Next. Power of compounding is also there, in SIP, SIP. SIP of rupees 1,000 invested per month at 8% per annum till the age of 60, you will get this much of returns. Starting at the age of, say, 4,20,000, this is how, if you start investing at this age, you will get at the age of 60, 23 lakhs. If you start investing at the age of 30, 15 lakhs, same amount. 35, 9 lakhs. See, 40, you will get this much only. I mean, that is why always early bird, catch the early bird. So you have to start investing from the day one when you start earning your income. Next. How the repeat cost averages, I have a NAV, we have already discussed how the concept of averaging helps in investments. This concept was given in 3 markets. One is the rising market. And say you started an investment at 10 rupees, when you, now the NAV is 18 rupees. So what happens? Because you are investing at various levels of NAV, your average purchase price of NAV comes to 13.58 only, instead of 18, which is the present rate. So average cost per unit is 12.92. This is how the rising market. Falling markets also similarly, it will help you to reduce your burden. Similarly, volatile market, everything is given in a tabular format. How the SIP will help you to protect your investments in rising market, falling market, and volatile market. Next. Systematic withdrawal plan, SIP type, that is SIP means investment plan. This is withdrawal plan, systematic withdrawal plan. So allows investor to regularly withdraw a fixed amount from their mutual fund investments. You invest a lump sum, and or you have accumulated a substantial amount. You can opt for that SWP, say starting from 1 year hence or 6 months hence. I want to withdraw every year this much amount from my mutual fund. That is called systematic withdrawal plan. This is how you will upfront give it to the mutual fund in distributor or this thing directly. Also, you can submit it. So accordingly, the mutual fund will pay as per your withdrawal plan. Next, how to invest in mutual funds. This is also finally having discussed several things about mutual fund. Finally, let us see how we should invest. What are the options available for investments in the mutual funds? Next. Yeah, be ready with your key investment prerequisites are for investments. Your KYC, PAN card, bank account details has to be handy. If you don't have this, try to obtain them. And then steps to complete KYC process. KYC means know your customer. Visit any mutual fund branch and then complete your this thing. There is a centralized KYC this thing for all mutual funds. Once you complete centralized KYC, you need not for investments in each and every scheme. You need not complete the KYC format, and you can quote your centralized KYC and then submit completed KYC form and then accordingly invest. That is so easy. Next. KYC is an acronym to know your customer. We already said that. visit your mutual funds registrar, transfer agent, or whatever it is, complete this KYC, and with this registered, when you submit it, you may get on hold or rejected. On hold means you have to wait. You will be maybe informed of maybe some certain shortcomings in that. The objective is finally your KYC is foolproof and you have completed thoroughly what are all the requirements, like your ID proof, your PAN card, and everything you have submit, and then accordingly it will be ready for your KYC to invest in mutual funds. Next, modes of investment: physical mode and online mode. There are two modes. Physical mode, there is paper-based traditional, like you have to fill up a form and blah blah blah, and physically submit it along with a check or draft. Then online mode is everything will be like in internet banking. You have to go and opening an account in savings bank account with banks, online mode. No, similarly, you can invest in online mode. Next, offline and online modes. The difference they have given. Bank draft and submit it to a mutual fund office or a registrar or transfer agent. Online mode is visit the website and buy the mutual fund units, visit the mutual fund utilities. This is entirely done in the system by your own user ID and password that was given to you when you opt for this type. Next, how to withdraw? Again, offline and online. There is a redemption form. Offline mode, that is physical mode. You have to submit a redemption request and then sign all the to be signed by all the unit holders, and accordingly the process will be given to the bank account that is notified. Similarly, online mode also, log on to the online transaction page and of the desired mutual fund where you are invested, and then accordingly select the scheme and how many units you want to redeem. You tell them that automatically it will be credited to your bank account as per the stipulated time intervals given in the scheme. Next, performance evaluation. Also, you can do not only just if you remember in the initial stage we said that you have to monitor your investments. You have to regularly monitor. So similarly, even if you invest in mutual fund also, we have to regularly monitor various schemes, how your fund is doing and other schemes are doing, whether switch option can be used when other funds are performing better than what you have invested for. Similarly, these are all the evaluation principles. Relative return with respect to its benchmark, and returns have to be compared with the fund's benchmark. An appropriate benchmark should be used to evaluate the fund's performance. Similarly, debt funds means also held for shorter periods. And similarly, depending on the scheme where you are invested, you have to compare with the benchmarks and the appropriate benchmarks and the evaluate the fund's returns. Then, as a risk, there is another concept called riskometer. The risk the fund is carrying is also depicted in a riskometer. Each fund has to tell what is the type of risk. If you are investing in that scheme, what is the type of risk you are going to undergoing? Maybe moderate, maybe high risk, maybe moderate risk, or a average risk type of thing. Let us see that. Next. Stress testing also is being done for each of the schemes. It's a computer simulated method to test how an investment portfolios may perform under extreme conditions. So this stress test means, as a commerce student, you must be knowing it. Stress test means what? And a different scenario building, different scenarios. If the Sensex is at this level, what will be the our fund will perform where? How the returns may be, not guaranteed, but how returns may be we can expect, type of thing. It will be average to moderate to higher risk. depending on your risk. That riskometer shows every scheme, what is the moderate risk that the scheme is. When you are investing in that scheme, what is the risk type of risk you are running, either moderate or average or small risk or higher risk type of thing. Next. This is another important concept called net asset value. Net asset value means each fund, when you have invested, that fund will disclose what is the net asset value of a fund on a daily basis. The net asset value of that your investment will be depicted in that mutual fund website. You can come to know of it. Even in advertisements also, whenever the advertisements comes, you will come to know of it. Other better is you have to go to the mutual fund and then accordingly know the net asset value of the fund where you have invested. How the net asset value will be arrived? The formula is assets minus liabilities by outstanding number of units, shares. The assets means what? The fund will be investing in various securities, bonds, shares. That is called real assets. Liabilities means expenses. What are the expenses that have been incurred by this fund? The value of the assets minus the expenses by the number of units of the fund. So you will get the net asset 10 rupees if you invest. Maybe over a period of time, maybe after 1 year, the 10 rupees must have been 12 rupees, 13 rupees, 14 rupees. Depending on that is called NAV, net asset value of that scheme unit. Next. Product labeling is riskometer. As I said, it shows low risk, low to moderate risk, moderate to higher risk. When a scheme is launched, the mutual fund will depict this riskometer. Depending on your risk appetite, you can take very high risk. When the riskometer is showing very high and your risk appetite, you can withstand the shocks in case if in adverse conditions, you can go for that type. Or else moderate risk on the scheme which is running a moderate risk, you can invest in that type of scheme. So that means what I was trying to tell you is you have abundant information to take an investment call depending on your risk appetite. Everything is provided in the scheme information document or scheme additional information or the key information management scheme document and the riskometer, fact sheet. All these documents are available for you to take an investment call with a lot of information based. That's what Madam also was telling in the informed decisions. Informed financial decisions. The principal Madam was in her original opening remarks, she said that it helps to take an informed financial decision. Next. Nomination facility is also available. You were all aware how nomination facility works, and you can now nominate up to 2-3 people now in the recent amendments, and the fund will be the transmission of the units will be easy if the nomination facility is there. It's mandatory now. There is no option for you. You have to nominate the persons of your choice. Up to 3 people you can nominate, and accordingly, in case of an unfortunate event, the transmission of this mutual fund will be easy. Next. Why is a nomination important? We are all aware of it. It's the most cost-effective way for making arrangements for transmission of the shares into nominees' names, minimal paperwork, maybe the death certificate and the nominees KYC and other things. Immediately the units will be transferred to the nominees' names. Next. A complaint redressal mechanism is also there in this. Each mutual fund has to have this, and they have to prominently advertise this and contact the investor relations officer of a mutual fund. And in case of if you have a grievance, you can flag those grievances with the people there, and accordingly that will be addressed. Next. SEBI also have an app called Sardi app, Investors Education. Very user friendly. It gives you wealth of knowledge. If you access that, you go for that app, you will, it gives you a lot of information, range of financial tools, calculators, everything that whatever the what you call layman can require, everything will be available under this Sardi app, under SEBI's website. You can go and access that. Use that for your investment decisions. Next. This is how the entire mutual fund industry works, and with various schemes and other things. So accordingly, we request you to plan your financial goals based on your income sources, and try to achieve them by investing in various asset portfolios, particularly mutual funds, where the your investment is taken care by expert hands like fund managers and other things. Of course, subject to the returns of the even in mutual funds are subject to market conditions. Read the SID, SIA, KIM before investing, and accordingly take a wise financial decision. Thank you very much for your patient hearing. Thank you, one and all.
Hello, sir.
Yes.
Hello, sir. Thank you for your insightful explanation, sir. So let us move towards a question and answer session, sir. There are some participants are having questions and doubts regarding the webinar, and they all have put it in chat box. That can financial planning help reduce tax liability?
Yes, definitely. That is how that we have already quoted ATC 1,50,000. In the investments in equity linked schemes, in mutual funds, definitely will give you an advantage. Other than that, you have the capital gains and tax is there in this. You have to bear that short-term capital gains and long-term capital gains. Better you consult your tax planner or advisor in this connection. But there are opportunities when investing in mutual funds. You can plan your tax in a better way. Okay.
Another participant has asked that how can a beginner start financial planning with a limited incomes?
Yeah, SIP is the best way. Systematic investment plan will help with a regular, even though it's a small regular income, you can go for maybe, as I told you, SIP works with even small amounts, 100 rupees, 200 rupees, 300 rupees also. Over a period of time, it accumulates. As you start earning, start the SIP method of investment, so that over a period of time, by the time you retire or this thing, a substantial savings can be there in the investment portfolio, and it will give you handful growth and as well as returns.
Thank you, sir. Another participant has asked that what role does risk profiling play in building a financial plans?
In my view, risk profiling is very, very important. Unless you are aware of your risk appetite, how much risk you can take with the source of income that is available with you, unless you are not aware of it, you cannot, choose take a right financial decision. So, risk appetite, arriving at your risk appetite and aware of your risk profiling is very, very important when you are going for investments. Yes.
So another is that is it good to invest in areas where leverage is high? How the leverage is to be considered? Maybe this question is from the mixed investment, sir. Like hybrid investment, she has asked that is it good to invest in areas where leverage is high?
Yeah, see the arbitrage fund, I said that, no, the leverage is, in the arbitrage. You have that leverage, in the arbitrage fund, it depends again, which type of investments or the scheme you have to choose in mutual fund is also dependent on your risk profiling or risk appetite. When you can take a slightly higher risk, go for equity schemes. And if you are a moderate, average to moderate and low risk appetite profiling is there, go for debt schemes. And hybrid schemes, slightly moderate to high risk, you can take. You can go for hybrid type of schemes where the returns will be maybe even if there is a slight volatility in one area, the other area will give you fixed returns, regular returns in that hybrid schemes. You can go as ultimately it is your risk profiling and risk appetite and risk taking ability that matters. Very, very important. Yeah.
Thank you, sir. Sir, can you please, my query is that still the people are depending on the older system of investments like gold and property and several aspects. So, see how the future trends are going to be in the concern with this online trading and online investments and systematic planning.
See, we have already said that you have to diversify your risk in various risk asset portfolios. I'm not telling that don't invest in gold or don't invest in real estate. It's you have to choose your risk asset portfolio in such a way, asset classifications in such a way that it balances the risk, it balances the returns, it balances the growth and the returns. Similarly, if you are going for gold and gold and real estate, slightly illiquid, and maybe gold is liquid, but when you go to a gold shop for redemption and other things, even though the rate what they're showing there, they don't give you some radhi, something they say that, and they will give you another value at that point of time. And see, and real estate illiquid in the sense, selling a property is not so immediate, unlike if you want urgently now. When you want that funds, if it is not helping you in leveraging it, so it's difficult to invest in that. Put everything in one basket in the real estate only. Put some of it in real estate, some of it in gold, some of it in equities or mutual funds. Diversify your portfolio. That is the objective of this financial planning, depending on again your risk profiling and appetite. Next.
Thank you for your insightful session and very transparent session wherein we can put our doubts directly to you and we can clear it. And I would like to inform all the participants to fill the feedback forms. And now I would like to request Dr. Sanjay Maneli sir to deliver the outcomes. Sir, your mic is muted.
Yes. You are telling me, sir, to the...
No, Sanjay sir, you unmute your mic.
Yes, Mr. Srikanth.
Hello.
Yeah.
Hello, Srikanth. I am audible.
Yeah, you're
Yes,
audible.
sir, you are audible, sir. You can continue with the comments.
Okay. honorable dignitaries, principal madam, keynote speaker sir, and dear participants. On behalf of Guru Nanak First Grade College, Bidar, and its entire fraternity, I feel immense pleasure convey word of thanks on this useful session, which is organized by Association of Mutual Funds in India and Commerce Department of our college. A national webinar on wealth creation through financial planning has been planned to enlighten all of us. I want to express my sincere gratitude to our principal madam, Dr. Shamala V. Datta, Guru Nanak First Grade College, Bidar, for their presence to gracious occasion. I also thank keynote speaker, Dr. Veera Brahma Rao, Senior Consultant, Association of Mutual Funds in India, and former General Manager of SBI. Sir talked about wealth creation through a financial planning. Thank you, sir, for enlightening all of us with innovative idea on financial planning. So last but not least, let me thank Dr. Hurnisa, HOD, Department of Commerce, for her constant support for organizing this webinar. So may these thanks of thanks to all the participants who attended this webinar with great enthusiasm, which made today's event a grand success. Thank you, one and all. Thank you.